All right, so we are entering the tail end of the second quarter of 2025, and there's been a lot of things that have happened this year with the new Trump administration coming into power, a lot of talks around what's happening with inflation, a lot of talks around global trade policy. That's basically been headline news across almost every media outlet over these last several months. So today, what I'd like to do is really talk about a couple of key points. Let's talk about the state of the markets. Let's talk about the state of the economy. And also a third topic we're going to discuss today is what should we expect throughout the remainder of 2025. While it's somewhat hard to predict, there are a lot of indicators that we can at least go over and give investors a good sense of where we've come so far and where we can continue throughout the remainder of this year. So let's first start with the state of the markets. So the markets have been definitely off to a very turbulent start, to say the least. We saw a very large decline at the beginning of the year around a lot of the trade policy. We've talked about this at great lengths, and everyone who has logged into their investment account statements, or I won't say everyone, but most folks that have logged into their investment account statements saw a very sharp decline. Now, obviously, we saw a very sharp recovery as well. And this is definitely rare. I think a lot of folks were not expecting such a quick recovery to the markets. Here at Vision Retirement, I say we're a little surprised at how quickly it recovered, but not the fact that it did recover. So remember, a lot of where the markets really fell is because of headline news, and there was really no supporting data to say the market should be down. We weren't seeing a slowing of the economy to a tremendous level. We are seeing the economy overall start to slow down as a byproduct of high interest rates set by the Fed and just sticky inflation. But we're not seeing recession level data. We're not seeing data of high unemployment. Although the labor reports that came out in the last couple of weeks were not as good as they have been. We're starting to see unemployment trickle up a little bit and payrolls start to decline. But that's really just a byproduct of how sticky inflation has been and the Fed being really persistent about not lowering interest rates too quickly. We're just seeing overall the economy is starting to slow down, which is really what we need in order for inflation to get under control. So those numbers aren't particularly surprising. It definitely was surprising that the market recovered so quickly, but not a surprise that it did recover at all, because again, a lot of the data that we saw wasn't data. It was just someone going online or reporting on TV or on social media saying, oh my gosh, the economy is in shambles, but there was really no proof that the economy was in shambles. And that's why we saw the market recover as quickly as it did. So definitely a good sign for investors. I think in terms of where the market is going to continue for the remainder of the year, we're not out of the woods yet. I think there still is volatility, but let's sort of transition now that we talked about the markets. Again, the markets have really recovered nicely. Let's talk about now the state of the economy, right? So the state of the economy is definitely somewhat fragile, I would say. It is held up really, really well despite everything that's been going on. Really, where I think that the economy might start to see some headwinds is we have somewhat of a mounting interest payment, right? So the US national debt right now is at an all-time high. And if we look at, I'm going to put a chart on the screen here. If we just look at the tax revenue that's being collected, interest payments that have to go out on this debt is at some of the highest levels we've seen basically since like the 90s. It's about 18% creeping up towards the 20% mark. So almost 20% of the tax revenue that the US government collects and the US Treasury Department collects is just servicing their debt. I mean, that is a crazy amount just to pay on existing obligations. And it's almost like a mortgage payment for them. A lot of US households tend to fall between the 20 to 25% range on what their mortgage payment is on their own income alone, right? If you make $100,000 a year, your mortgage might be $22,000 a year as an example, right? 2%. It's for them, it's like literally owning a house, but the the value of the house is not increasing, right? They can't go back and leverage the equity out of it. It's just a rising debt. So I think that's where a lot of the issues really need to be addressed. And what the Trump administration is trying to do to address some of these issues is really around tariffs. Economists right now are forecasting that, and we're going to talk a little bit about tariffs. I know everyone's sort of waiting for this because there's been some recent headlines on this, but economists are estimating that over the next 10 years, the additional tariffs could bring in roughly $2 to $3 trillion of revenue. So that would definitely help at least sort of mitigate some of the ongoing expenses of the interest payments. So I think that definitely will help, but it's not the end all be all solution. I think the US government is going to have to figure out how to A, reduce their spending in one way, shape, or form, B, increase tax revenue to offset spending, or C, a combination of both, decrease spending and increase revenue from some source. And obviously, the easiest source to collect it from is probably the existing citizen base, right? They can raise tax rates, and we haven't really gotten a lot of clarity yet, but more and more information is going to be released. I'm sure right now a House bill has been presented. I don't want to talk too much about it yet because I could say one thing and then the bill might get completely changed, vetoed, removed. It could be partially passed, partially not passed. So I don't want to talk a little bit about that because I think it's still too speculative at this point about where tax rates are going. As a reminder, tax rates are expected to sunset at the end of this year, barring any decision by Congress. So if Congress does not make a decision on tax legislation, we will revert back to the tax rates of 2027, which on average are higher for probably 95% of the population, maybe a little bit more. So just keep that in mind. I don't think that we'll see a complete sunset because they are starting to talk about it, at least down in Washington, D.C., but we just don't know enough information. And our plan here at Vision Retirement is to actually release a live webinar talking about a lot of the tax changes. So if you want to learn more, definitely subscribe to our page, follow us, because we will be releasing a lot of relevant information around the tax changes later this year. So state of the economy, just to summarize, right? I think overall it is okay, but we are seeing a slowdown. The Fed is going to be very mindful of interest rates because they still don't know what's happening with tariffs. So let's transition to topic number 3, which are what should investors expect through the remainder of the year? And a lot of it is going to really be tariff driven. And you could say, well, Ben, the international U.S. International Court of Trade or Trade of Court just put a ban on a lot of what President Trump is doing in regards to his tariffs. And you're absolutely right. They did put this ban in effect. Now, with that in mind, President Trump and really any sitting president, right? It's not unique just to President Trump. It's any president that's in power can enforce a lot of these, I don't want to say loopholes, but they can elect to take advantage of certain provisions in the law that would allow them to really overrule or override any court decision by use of executive power. So again, I think that that's probably the next path. And what I'm going to do is there's different sections that allow it. I'm not an attorney, right? So I don't want to really go too much in detail of the different sections that could allow it, but I will put it up on the screen, an image here. There's really 4 main avenues that President Trump can pursue across different sections. And most analysts are anticipating he'll probably go down the route of the first one, which is Section 338. Again, I'm not going to talk about it much. I'm just going to put this definition on the screen for everyone here to sort of read and digest. But to summarize is that any U.S. president does have the ability to bypass a lot of the courts and their decisions when it comes to enacting tariffs. So while President Trump has hit somewhat of a roadblock, he definitely can override a lot of these court's decisions and go back and say, you know what, I still have the ultimate say, and I can still implement tariffs as I see fit. So that will definitely create additional market volatility. We've really seen the market rebound since because he put that 90-day tariff pause, reciprocal tariff pause, mainly on China and other countries. We're seeing now that he has this ban to sort of overcome, but a lot of analysts are anticipating that he still does want to implement sort of a blanket 10% universal tariff on all goods being imported into the United States. We think that it's likely on average tariff rates across the board, right? Then some tariff rates will be higher, maybe for like auto goods out of Korea, or maybe chips coming out of China, right? Those might be higher rates, but then there's going to be other products and services and goods that are going to be at lower rates, maybe just at the 10% universal rate. So we think on average across all tariffs that are likely to be implemented, it probably be in the high teens, maybe low 20s, but more so high teens. So think 17, 18, 19% on average. And again, this is somewhat of an estimate. We don't know where that's going to be, but that's where I think a lot of the volatility is going to come from. Again, it's data that we really haven't seen the effects of yet, because at the moment it's not implemented. But the headline data we have seen, probably the craziest that I've seen as long as I've been alive, pretty much, barring maybe the financial crisis of 2008, or 2007, 8, 09, where we saw the news sort of say, everything's hitting the fan, right? To put it lightly. We saw such a reaction by markets that really it was just unprecedented. It's never really happened before, and that's just due to the fact that so many people have access to immediate information today compared to 10 or 15 years to now. Basically, everyone I know has a smartphone. If you don't have a smartphone, it's because you're under the age of 10, right? And your parents just haven't allowed you, or just haven't gotten around to buying you a smartphone yet. But, I mean, kids have smartphones, adults have smartphones, older folks have smartphones, grandparents have smartphones. Everybody has access to the same information. And we all, at the same time, if one headline gets dropped, and if everyone has an iPhone, as an example, and Apple News reports that tariffs are being implemented, right? That's millions and millions of people, maybe even billions of people across the world that are getting that same news at the same time. And they can, if they choose, they can instantly react and make a decision in the market when it comes to their investments, right? They can sell, they can buy, they can do whatever they need to do. And that's where we saw such a reaction to headline data over these last few months. And it wasn't even data, I'm sorry, just headline news, right? The data, on the other hand, is a completely different story. We haven't even seen a lot of the tariff data really come in, because it was just conversations about tariffs that haven't even happened yet. So the point that I'm trying to make is that volatility is definitely here to stay. Again, we don't know how severe it will be, but we do expect a turbulent ride over the remainder of the year. We still feel that the markets will end on a positive note by come the end of the year, especially as we get more clarity on what's happening around the tax laws. I think we'll get more clarity around the overall state of economy, especially once the tariffs actually start to stick, right? Really, markets are reacting on news about tariff uncertainty, because tariffs are coming, they're going, they're changing, they're doing this, they're doing that. But once we know this is what tariffs are going to be, markets can react with some degree of certainty and say, okay, we can sort of predict the future because we know what's going to happen. Tariffs, at least for now, are not going to change. And I always love the quote. This comes from our founder, Paul Mueller here, is markets can handle good news, they can handle bad news, but they can't handle uncertainty. And that's really what we saw, right? Is we saw the market not being able to handle uncertainty around the tariff headlines. So again, to summarize, when it comes to thinking about the state of the stock market currently, again, we've sort of rebounded, and a lot of folks are back to where they originally were at the start of the year. It definitely was not a smooth ride, but at least most folks have recouped their losses, and maybe even potentially capitalized on some tax loss harvesting strategies. In terms of where the stock market is going the remainder of this year, again, I think we'll end on a positive note, but I don't expect it to be a smooth ride getting there like we've been so used to over these last couple of years. The state of the economy overall, it is in good shape. It's definitely slowing down, and I think the Fed is very mindful that it is somewhat fragile at the moment. They're being very, very cautious about interest rate movements. They're really trying to avoid lowering rates too extremely, meaning too quickly, right? And too much at once. So I think that if they do start to lower rates, it'll be very small bite-sized pieces, almost to sort of like gently poke the bear and say, hey, we don't want to wake you up out of hibernation just yet, but we want to see how you're feeling, kind of thing. And I think if the bear growls back, they'll take a step back and say, okay, we'll let you be. And if the bear is okay with being poked, then they might continue just to say, okay, we can continue to possibly lower rates. And just the state of the market for the remainder of the year, again, I think we'll end up on a positive note, but there will be volatility, and hopefully once we get some more clarity around the tax law changes, we'll have a better understanding of where most folks are going to be filing their returns and how much they're going to owe, or maybe get a refund in future years. So if you want to learn more, definitely subscribe to our page. We post all of our information around our live webinars on all of our socials. If you want to follow myself, Benjamin Stark, CFP, on LinkedIn, I post everything there. If you want to follow any one of us, you can follow our Vision Retirement page on LinkedIn. You can follow Vision Retirement here on YouTube, and really just check us out, learn more on our website. We are going to be sharing a lot of information because there's going to be a lot of significant changes, especially around tax law, as the year progresses. So with that in mind, thank you so much for tuning in to today's video. I am trying to do these longer videos just for everyone's awareness. Typically once a month now. I used to do them once a week, and I'm going to do longer videos once a month, and then hopefully get out some shorter, quick summary updates, 60 seconds or less. We'll do some little 60-second finance videos once a week, and we'll post those as shorts. So feel free to like, subscribe, comment, share below, and I look forward to seeing everyone soon.